Layer 5 is the non-bank and shadow finance universe. Everything that channels credit or liquidity outside the regulated balance sheets of banks and insurers. Think of hedge fund leverage, money market funds, private credit vehicles, fintech lenders, stablecoins, even leveraged LDI pension funds. This layer is where innovation flourishes and where hidden fragilities often incubate. Broad measure, NBFI sector. Across the 29 jurisdictions, the FSB surveys non-bank intermediaries held $243 trillion of assets at end 2023. 49% of global financial assets after growing 8.5% in 1 year, more than twice the pace of banks. Narrow shadow bank slice. Activities that combine maturity transformation, leverage, and liquidity promises. Fixed income and credit funds, finance companies, broker-dealers, SIVs, total $63 trillion, roughly 14% of global assets. Fastest growing pockets. Private credit AUM leapt past $2.3 trillion in 2024. Open-ended bond ETFs now top $1.9 trillion. Decentralized finance total value locked hovers near $110 billion despite crypto winter retrenchment. Segment, typical vehicle, core revenue engine. Money market and short-term funds, 2A7 MMFs, LVNAV funds, EU. Yield on T-bills, repo, and CP. Zero-day liquidity promise. Credit and bond funds, ETFs. Open-ended mutuals, passive ETFs. Fee on AUM, transform illiquid HY bonds into daily tradable shares. Hedge funds and family offices, master feeder funds, segregated mandates. Alpha plus leverage via TRS, repo, listed futures. Private credit and PE, BDCs, direct lending funds, CLO warehouses. Originate loans to sub-IG corporates, charge spread and fees. Finance companies, fintechs, BNPL, P2P, neobank balance sheet. Underwrite consumer, SME credit, outside deposit insurance. Structured vehicles, REITs, MBS trusts, asset-backed CP conduits, pass-through cash flows, rely on wholesale funding, crypto and DeFi, stablecoins, AMM pools, yield farms, token seniority, automated market-making spreads. Credit provision. Shadow banks fund 60% of U.S. corporate leveraged loans and over half of emerging market hard currency bonds. Market liquidity. Bond ETFs and hedge fund basis trades supply the bid-ask every pension fund relies on. Risk transfer. Banks offload balance sheet risk via CLOs, TRS, and sponsored MMFs, so stress in Layer 5 boomerangs back to Layer 1. Maturity liquidity mismatches. Daily redemption credit funds hold assets that can go no bid, as seen in the March 2020 Dash for Cash. Hidden leverage. Total return swaps let actors like Archegos 2021 build 8 to 10 times gross exposure with minimal disclosure. Collateral chains. Rehypothecation via prime brokers and FICC repo nets can jam if haircuts spike. Margin spirals. Rapid gilt yield surge in September 2022 forced UK pension LDI funds to raise £140 billion cash in days, triggering fire sale loops. Tech and operational fragility. A fintech lender, or stablecoin, can scale to millions of users faster than regulators can impose resilience tests. Terra Luna's 2022 collapse erased $45 billion in days. Year. Event. Lesson learned. 2020. Pandemic dash for cash. Run on prime MMFs. Fed creates MMLF and CPFF backstops. Even cash equivalents can freeze without lender of last resort lines. 2021. Archegos family office implodes via TRS leverage. Bank, prime, broker desks, underestimated concentrated positions. Pushed Basel to tighten client-level margin floors. 2022. Terra Luna algorithmic stablecoin death spiral. Stablecoins without credible reserve assets can mimic bank runs. 2022 UK gilt LDI crisis after mini budget. Leverage in non-bank balance sheets can transmit fiscal policy shocks to sovereign debt markets. 2023 US regional bank turmoil. Uninsured deposits flee to MMFs. Non-banks siphoned liquidity, forcing Fed's BTFP facility to stem outflows. FSB toolkit. Minimum margin haircuts on securities financing. Cash buffers for MMFs. Data collection on hedge fund leverage. Consultation on leverage metrics published December 2024. SEC, MMF, and open-ended fund reforms. Swing pricing or anti-dilution levies slated for USHS. Fund extended in 2026. Daily liquidity bucketing disclosures start Q4 2025. IOSCO good practice for leverage and liquidity. Global template for fund ex-ante stress tests. Due to become a supervisory expectation in G20 markets by end 2025. Bank of England NBFI stress firewall. Regular multi-sector simulation. Banks, insurers, CCPs, LDI funds. To map collateral calls and default waterfalls. Crypto perimeter. EU MiCA. Enforce mid-2024. US Fed FDIC SEC stablecoin draft would require one-to-one reserve segregation at a Fed-supervised bank. Data Gaps Task Force. BIS, FSB, and IMF mandate. Granular hedge fund and family office derivatives. Reporting by 2027 using ISO 20220 tags. Tokenized real-world asset funds. On-chain SPVs promising T+0 settlement of trade finance receivables. AI-enabled credit scoring. Fintech lenders scraping alt data to approve microloans. Model risk and bias under scrutiny. Programmable money market funds. Smart contracts. Auto-gate redemptions once NAV deviates beyond preset basis points. Composable leverage loops in DeFi. Flash loan-powered arbitrage can topple under Oracle manipulation, making protocol-level circuit breakers a new systemic safeguard. Layer 1. Central banks. Non-banks depend on bank credit lines and repo with central bank-eligible collateral. In crises, facilities like the Fed's MMLF morph shadow risk back into public balance sheets. Layer 2. Regulators. FSB sets the cross-sector playbook. FATF travel rule now covers crypto mixers. Bank for international settlements, coordinates, data gap closures. Layer 3, infrastructure. CCP margin spikes or settlement blockages cascade fastest to leveraged funds. CLS and DTCC expansions include buy-side direct access to reduce dependency on dealer intermediation. Layer 4, megabanks and asset managers. Prime broker leverage decisions, ETF share creation processes, and fund-to-fund mandates define the pace and plumbing of shadow flow transmission. Liquidity buckets. Classify assets by realistic sale horizon, not headline rating. Assume multi-day liquidation for emerging market high yield, mezzanine ABS, and DAO-governed tokens. Counterparty mapping. Trace repo, prime broker, and OTC derivative exposures to the same megabank anchor. Avoid correlated margin calls. Stress, fund run pathways. Model simultaneous outflows from ETFs, MMFs, and DeFi pools feeding into CP rates and dealer balance sheet capacity. Collateral eligibility drift. Monitor CCP updates. A shift from cash to non-cash margin can drain T-bill availability for repo financing. Regulatory cliff edges. Anticipate EU swing pricing, US end-of-day illiquids caps, and MiCA reserve audits in term sheet covenants. Scale versus opacity. NBFI assets could top $300 trillion by 2027 if growth stays twice the banking pace. Supervisory data quality currently lags far behind that scale. Macro headwinds: higher for longer policy rates test unhedged carry trades. Property fund NAVs face dual drain of refinancing cost and ESG retrofit bills. Geopolitical bifurcation: sanctions, data localization, and competing CBDCs fragment funding pools. Non-bank conduits and neutral hubs, UAE, Singapore, Switzerland, may grow systemic relevance. Climate transition: stranded asset risk migrates. Private credit loans to fossil infrastructure bypass bank green capital rules. Climate stress penalties could redirect flows abruptly. Tech and cyber. Tokenized settlement and on-chain funds promise T+0 liquidity, but enlarge smart contract and oracle risk. Deepfakes become a new fraud vector in P2P lending. Bottom line: Layer 5 is the financial system's wild frontier. Half the world's assets, lightly regulated leverage, and innovation that can outpace supervision in months. Its contribution to growth and market efficiency is real, but so is its capacity to channel stress back into every other layer. Master its instruments, monitor its data gaps, and engage early with evolving policy if you want to thrive rather than merely survive the next liquidity squeeze.